For 30 years, one central bank kept the world's cheapest money flowing. It almost never moved. It almost never made headlines. Other central banks shouted. This one stayed silent. This week, the Bank of Japan raised its policy rate to 1%. That is the highest level since 1995. A quarter-point move that sounds tiny on paper, but it may be one of the most important rate hikes on Earth. You might think a Japanese rate move has nothing to do with you. But Japan has quietly helped fund markets from New York to Mumbai. Cheap yen became a hidden fuel under global finance. Think of it as a low hum beneath the world's markets. When that fuel gets more expensive, connected markets can shake. Stocks, bonds, currencies, even your pension could feel it. To understand why, we have to go back 30 years. In the late 1980s, Japan looked like the future. Its stock market and property prices soared to extraordinary heights. At the peak, by some estimates, Tokyo land rivaled all of America. Confidence felt limitless, and credit was everywhere. Then, at the start of the 90s, the bubble burst. Asset prices collapsed and took years to recover. Banks were left holding loans that could not be repaid. What followed earned a haunting nickname. Economists call it Japan's lost decades. Growth largely stalled for years on end, and the country fell into a rare trap: deflation. Deflation means prices broadly fall year after year. That sounds nice, but it can quietly poison an economy. If things get cheaper tomorrow, why spend today? Multiply that hesitation across a whole nation. When people wait to spend, businesses sell less. Selling less, firms may cut wages and jobs. Lower wages can mean even less spending. It can become a spiral that is hard to escape. Debts also grow heavier when prices keep falling. Japan fought this dynamic for a generation, and its main weapon was the price of money itself. To fight deflation, the Bank of Japan cut rates toward zero. It even pushed rates below zero into negative territory. At times, parking cash effectively carried cost. The idea was simple: make money so cheap people would use it. Borrow, spend, invest, and pull prices back upward. For years, Japanese borrowing costs were among the world's lowest. And that single fact helped create a global money machine. Japan is one of the largest creditor nations on the planet. It holds enormous savings and assets around the world. Decades of careful saving piled up vast wealth. At home, that money earned almost nothing. Abroad, it could earn considerably more. So money flowed out, chasing higher returns. And a clever, powerful trade took shape. It is called the yen carry trade. The recipe is surprisingly simple. First, borrow yen, where interest is very low. Then convert that yen into dollars or other currencies. Finally, invest it in something that pays more. Pocket the difference, then repeat at scale. It is a bet on cheap borrowing meeting richer returns. Imagine borrowing yen at close to 0%, then buying assets abroad yielding several percent. The gap between the two becomes your profit. It is like renting money cheaply, then lending it dearer. Now scale that up by hundreds of billions of dollars. Hedge funds and global investors leaned into this. Cheap Japanese money quietly helped bankroll assets worldwide. For years, this trade ran largely one direction. Japanese rates stayed low, so money kept flowing out. It became like invisible plumbing under the world economy, quietly supporting stocks, bonds, and currencies far away. Most people never knew it existed. But a trade this large carries a hidden danger. It works best while the yen stays cheap and weak. The carry trade has two main enemies. One is higher Japanese interest rates. The other is a suddenly stronger yen. Higher rates make borrowing yen more expensive. A stronger yen makes paying it back costlier. Suddenly, the easy profit can flip into a loss. When both turn at once, the trade can reverse fast. An unwind means investors rush to undo the trade. They sell assets abroad to repay yen loans. Heavy selling can push prices down across many markets. Falling prices can scare more investors into selling. Everyone heading for the same exit at once. Money floods back into the yen, pushing it higher. And we're not just guessing. We have seen it. In August 2024, Japan nudged rates higher. It was a small step, but the timing caught markets off guard. The yen jumped, and the carry trade began to unwind. Investors scrambled to sell assets and repay yen loans. Markets across the world dropped sharply within days. Japan's own stock market saw one of its worst sessions on record. The shock rippled into the United States and beyond. It was a preview of how fast this plumbing can strain. The selling did calm within weeks, and markets steadied. But the episode left a lasting warning. A quiet, decades-old trade could move fast and violently. Even a gentle hike could echo across the globe. Traders now treat every Tokyo decision as global news. So this latest hike lands with that memory fresh. So a 1% rate is not just a Japanese story. It shifts the math on trillions in global positions. Each step up can narrow the carry trade's profit. The cheaper the borrowing was, the bigger the shift feels. And it strengthens the pull drawing money home to Japan. That is why traders worldwide watch Tokyo so closely. But there's a deeper reason this hike is so delicate. Japan carries one of the heaviest debt loads on Earth. Government debt sits well over 200% of GDP. That is more than twice the size of its entire economy. For decades, carrying it was relatively painless, because near-zero rates kept the debt cheap to service. Much of it is even owed at home, which helped. Now, that quiet arrangement is under pressure. When rates rise, the cost of servicing debt rises too. On a debt this large, even small increases add up. A fraction of a percent can mean enormous sums. More of the budget may go just to pay interest. That can leave less for everything else a country needs. So the Bank of Japan is walking a tightrope. Raise too fast, and the debt bill could grow heavy. If hiking is so risky, why do it now? Because doing nothing carried its own growing cost. Staying at zero forever has consequences too. Two forces finally pushed the Bank of Japan to act. One was the long, painful weakness of the yen. The other was inflation creeping back at last. Let us start with the yen. For years, the yen drifted toward multi-decade lows. Low rates at home made the currency less attractive to hold. A weak currency can help exporters sell abroad, but it also makes imports far more expensive. Japan imports much of its energy and food. So a weak yen quietly raised the cost of daily life. And ordinary households felt the squeeze. Then a new shock arrived from abroad. War in the Middle East pushed energy prices up. For an import-heavy nation, that fed into inflation. Costlier fuel rippled into food, transport, and goods. Suddenly prices were rising, not falling. The Bank of Japan pointed to these inflation risks directly. After decades fearing deflation, the worry had flipped. Weak yen and rising inflation pointed the same way. Higher rates can help support a sinking currency. They make holding yen a little more rewarding again. And they can help cool inflation before it spreads. So the Bank of Japan raised by 25 basis points, lifting the policy rate to 1%, the highest level since 1995. Now, there is a hopeful way to read all this. A rate hike can be a sign of health, not danger. It may mean Japan is finally escaping deflation. Mild inflation and rising wages can lift an economy. When workers earn more, they can spend more. After 30 stagnant years, that would be remarkable. Some see this as Japan slowly returning to normal. For decades, near-zero rates were emergency medicine. No economy is meant to stay on that forever. Ultra-cheap money can distort savings and investment. It can prop up weak firms that should have faded. Lifting rates gently can rebuild healthier conditions. Savers might finally earn something on their cash. In that light, the hike is cautious, not reckless. Still, the optimistic view has clear limits. A faster carry trade unwind could jolt global markets. The debt interest bill could climb uncomfortably high, and domestic growth still looks fragile. If consumers pull back, recovery could stall again. Wages may not keep pace with rising prices, so the bank must move slowly and carefully. Broadly, two paths lie ahead. In one, Japan normalizes gently and the world adjusts. Inflation settles, wages rise, and confidence returns. The carry trade winds down slowly, without panic. In the other, the hikes come too fast or too far. Markets wobble, and the debt burden bites harder. Which road we take is still being decided. So what should you actually keep an eye on? First, where the yen trades from here. A sharp jump could signal another unwind. Second, the bank's next signals on future hikes. Slow and steady would calm nervous markets. Third, whether global stocks stay steady or shudder. And finally, whether Japanese wages truly keep rising. You may never touch a yen in your life, but global markets are deeply interconnected. Pension funds hold the assets this trade touches. Big market swings can ripple into retirement savings. Borrowing costs and currencies can shift too. That is how a Tokyo decision can reach your wallet. Distance does not mean disconnection. Step back, and the story is really about an ending. The era of endlessly free money is fading. Around the world, cheap borrowing defined a generation. Japan was the last great anchor of that age. As it shifts, the whole system recalibrates. That adjustment can be healthy, or it can be bumpy. Often, it is a little of both. It is worth being honest here. No one knows exactly how this plays out. Central banking is judgment under deep uncertainty. Smart people disagree about what comes next. Forecasts are guides, not guarantees. What we can do is understand the forces at work and watch how they unfold from here. Let us pull it all together. Japan crashed, then fought deflation for decades. Near-zero rates birthed the global yen carry trade. That cheap money quietly funded markets worldwide. A weak yen and new inflation forced the bank to move. It raised to 1%, the highest since 1995. And the whole world is watching what happens next. One more thing before we close. This video is for information and education only. It is not financial or investment advice. It is analysis of the forces, nothing more. Markets are uncertain, and every situation differs. For decisions about your money, consult a professional. Understand the forces, then choose carefully. For 30 years, the Bank of Japan stayed quiet. Now it has spoken, and the world is listening. A single quarter point may reshape global money. Sometimes the smallest moves echo the loudest. Thanks for watching Chronicle. We'll keep tracking this. Stay curious, and we will see you next time.